everyone. Welcome to today's workshop. We're doing this. It's a special one for me, at least, because we're with Joyce Rojas. She is connecting all the way from New York. New York or New Jersey? Where are you at right now?
New Jersey.
New Jersey. She's back and forth. And with Ferdinand Ruano. Joyce Rojas, by the way, congratulations on being a bestseller with your latest book on Amazon.
Thank you. Thank you. It's called 31 Badass Money Mindset Affirmations. And I actually think it's a very good book, but not because I wrote it, but because I've heard from people that have read it. But thank you so much.
And then we have Ferdinand. Some of you already know Ferdinand. Ferdinand is started as a Wall Street guy. They call him the Wall Street developer because then he moved on to real estate. He's never left Wall Street entirely. He loves that world. And some highlights of his career are he worked helping Nelson Mandela raise money for his government when they switched governments, and was part of the EQ project before it was called Euro. So you have two very powerful, very knowledgeable people here, and I am so excited to be asking some of the questions. If you have asked questions about the economy, by the way, feel free to leave them on the chat. Today we started with, the oil futures dropped. Bloomberg is telling us inflation is going up, nothing new there. Russia is still, we don't know what's going to happen here, right? And there's even talks about stagflation. Stocks in Europe are not doing very good. There's a lot of changes happening, and some of the stuff we see on the media is highlighted in a more aggressive way to just get your attention. Other stuff is stuff that you should worry more about or consider. And that's why we are bringing today two experts that are going to talk and tell you what's the reality of the situation, what we're living in today, and how there's always opportunity in every market, right? So I'm going to start with Joyce, with the lady. Joyce, how do you feel? What's going on in the economy, in your own words, today?
What's not going on in the economy? So there is a lot. There's a lot going on. We see stocks were at very high prices, right? We just came out of a pandemic. During the pandemic, we saw the market go down. It was about 35% down. Then a really quick liftoff, okay, which is understandable to an extent. And so that quick liftoff should have raised eyebrows. And for me, at least it did. And so it's not surprising that we saw the market come down again, because everything is a cycle, which I'll probably touch upon later on. But right now where we are is, yes, the market's taken a little bit of a breather. But the other thing is that real estate is also pretty high, right? So right now, I think that people are wondering, where the hell do I put my money? Do I put it in crypto, which is a little bit, we can't really trust it completely yet, right? And that's another thing that's, if you look at the charts, it's gone up so fast that you tend to wonder what the next step in crypto is. Do I put it in real estate? Well, the prices are pretty high in real estate too, so it's a little bit tough to trust that. Do I put it in stocks where there may be a recession right around the corner? Where am I going to put my money? Or do I put it in a savings account when inflation is at 7 to 8%? And so I'm really not making anything. I'm actually losing money by putting it in a savings account. So that's where we are. That is the current market right now. And so I could understand why so many investors are wondering what is happening. So we'll give you a little clarity today about that.
Ferdinand, so tell us your view of the economy right now. I like what Joyce said, and I think she she started with the right questions. I think it's where the mindset of a lot of people are. Okay, where do I go, and where is the economy going, so that I can make the right decision. So, Ferdinand, what is the state of the economy right now for you?
Well, right now the economy. First of all, thanks for the opportunity. I'm joined such wonderful people and very professional people, distinguished people. Basically, I just want to let you, I think that you got to go with the facts. First of all, what is the fiscal policy? What is the Fed policy? And what is the valuation of the different markets? Right now, let's talk about the Fed. The Fed has made a big change in December, where it changed from an easy money policy, quantitative easing. We're in a transition to a quantitative tightening, which means that they're going to diminish balance sheet. And at the same time, from a dovish stance of lower interest rates to higher interest rates. Second major thing is that inflation is here to stay. And as I did in my radio show 8 months ago, it's not transitory. It's going to be here for a while. And when I mean a while, I mean 2 years. And you better get used to 4-5% inflation for the next 24 months. Ukraine hasn't helped the situation. Oil is not helping the situation. Commodities and grains is not helping the situation. So basically, you have to change your approach to traditional assets to probably non-traditional assets. And the other thing very important is that based on valuations in the market right now, in the stock market, the S&P right now is fairly valued. If you look to $232 in earnings in the index, you multiply that by a 20% price earnings, that means that the market is currently fairly valued. But when you discount the cash flows with a higher interest rate scenario and higher inflation, stocks, they don't do that well. What the things that do well in an inflationary, higher interest rate scenario are probably natural resources, tangible assets, and real estate. And that's where I stand.
Okay, so and we're saying there's an opportunity everywhere, and you mentioned some of the things that you mentioned. You can actually invest on those through the stock market, and so there's an opportunity everywhere. But I guess most folks believe that diversification is the way, right? But how to diversify in a market like this is going to be key as well. And it's all going to depend on each person's situation. So let's start, because you both mentioned a lot of things that are happening. You said inflation's going to be here for at least a couple of years. Joyce, you agree on that?
I do. Mm-hmm. I do agree on that.
By the way, just so you know, nothing here is advice about how you should invest. This is just information for all of you. Okay, we want to make sure at the end of the day, each person has a different situation. Each company has a different situation, and neither Ferdinand or Joyce Rojas are giving you personal advice here that you can apply to your own investments. Okay. This is just information that can help you make decisions, but we always recommend you go to a financial advisor and figure that out with a person that knows your particular situation. Okay, so the economy, where the answer to one of the questions we got is, where do you think the economy is going to? And answering this question is a little bit hard, right? Because we just mentioned there's a lot of pieces there. You mentioned oil and you mentioned Russia. I want to touch on those things. They're kind of like linked in a way. So I want you guys to tell us a little bit what you think is happening there and how it could potentially continue to affect the situation right now. You can start.
Okay, so Ferdinand, one of the things Ferdinand mentioned is A couple of things, right? So we're talking about a lot of things right now, but let's go with the inflationary environment. So yes, the inflationary environment, it is here to stay. We have to remember that the Fed had for many years made it very easy. So there was very easy money in this economy, and now what they're trying to do is they're trying to pull it back. So there's a lot of things that are happening. So is inflation here to stay? Yes. Are we looking at where is there opportunity? And yes, there is opportunity in certain asset classes, oil being one of them, commodities in general being one of them. And that is directly being affected by the Ukraine and Russia war, because you have to remember that obviously Russia was one of the biggest exporters of oil. They were also a big export of wheat, grain, so these things are going to affect the normal consumer here. And we think that it's not going to hit us, but it does. It hits us not only in gas stations, but it hits us in even the grocery stores. When we go there, when we go out to restaurants, if you noticed, when you go to your restaurant, the prices are higher. When you get your nails done, the prices are higher. Everything is going to be higher. And so then that's how the whole Ukraine situation is affecting us. And it could continue to do so until something happens. If they say, okay, you know what, we are coming to an agreement, which doesn't seem likely. I mean, there's starting to be possibility of that, but I mean, you never know with Putin. So that's a possibility, but we're kind of depending on that. But even totally aside from that, we have to also remember what's happening in the US when it comes to, okay, it is an inflationary environment, and how is the Fed going to be able to raise rates without leading directly into a recession? And that's going to be a tricky thing. It has been done in the past, but we have to see if it's going to be able to be done again.
True. Ferdinand, what are your thoughts on that? I mean, I know you are a firm believer that every economic cycle has different opportunities, and that there's some really good opportunities right now as well. But where do you see this situation going?
I think Juliana and Joyce and all the people that are joining us, basically the opportunity is going to be, number one, you got to understand that interest rates are going to go higher. Number two, inflation is going to be higher. And when I mean higher, probably we're going to have the lowest real rates of return in the bond market for a while. In rice and beans means that if you're making in a treasury yield, in a treasury bond of 10 years, 2.35%, and inflation is running at a 6 to 7% clip, as it's doing today, probably is one of the worst negative real rates of return that you ever had in the last 25, 30 years. So basically, there's going to be a dislocation and a movement out of fixed income alternatives into other types of alternative investments. If you look the studies of the endowments like Harvard and Yale, right now, I was in a family office meeting. 47% is out of the stock and bond market as we speak today. Mostly are in different private deals. When I mean private deals, means private lending, private investment in real estate, private syndication, private ventures, private equity. And that's what we're seeing right now. There is a lot of opportunity in commodities. Right now, if you look at the statistics, for the last 20 years, there are three sectors right now that are very compatible with an inflationary environment. And I will answer this. It's not bonds, it's not stocks. It's infrastructure, it's natural resources, it's energy, it's dividend-paying stocks with value, and the other thing is real estate. And I'm going to touch in the single family because there is a huge opportunity in multifamily and single family residence. That's where the money is right now.
So when you say that's where the money is right now, you're talking about inflation going up. I think you said 6 to 8% per year, which means we got to make sure that for us to not get stuck, that we're growing our personal incomes or businesses at least 10% per year, right? So
right now, the numbers right now, they are exaggerated and they're dislocated by this huge supply chain disruptions. And now with Ukraine, when those things fade out, which we expect to be in the next 6 to 8 months, based on our charts and based on our analysis and oil prices, basically, I believe that inflation is going to come down, but not so down like we are used to on that 2% clip. What Joyce mentioned is what I call the Fed mistake. Usually Fed always is too late into the party. They tie too soon, or they do it too much, either easy or tightening. And right now, the Fed funds future and the euro dollar futures are signaling that we're having a 35% chance that the Fed is going to tie too much. And that can cause what it's called an inverted yield curve, which means it's a recession in the next 12 to 18 months. Right now, we're on a 35% chance as we speak. But inflation is not bad. Let me clarify this to the audience. The press has demonized inflation. Inflation is not bad. Inflation means that we're having huge demand and huge amounts of economic activity. Don't miss the eye in the ball.
We just got to keep up with it.
GDP is growing in the United States almost double of China. China is in lockdown. Shanghai is in lockdown. Hong Kong is a disaster. US is not in that position. Right now, of all the industrialized nations, US has the best position economically and dealing with the COVID situation. So the reason of inflation is because it's too much money chasing few goods because there is not enough of them.
Okay, but that's, there's a point where that can become an issue. And we're also seeing, and I think this was one of Bloomberg's articles yesterday saying, hey, the US has the most chances right now of going into stagflation. And I would like Joyce, I don't know if you have anything to answer to what Ferdinand said before, and if you can touch on stagflation as well.
Okay, so yeah, I do want to just mention a couple of things, opportunities now, because I think that's one of the things that is on everybody's mind. I mean, a lot of what we talk about, you can hear on the news, but the normal person doesn't understand what the hell's happening in the news, right? When they talk about inflation, when they talk about stagflation, when they talk about inverted yield curve, most of my clients are like, what the hell is that? And so what does it mean to you is the important thing, right? And one of the things that's on people's mind is, where the hell do I put my money? That's pretty much it, right? And what do I do? What am I supposed to do? So Ferdinand mentioned a couple of things where it's like, is there opportunities? Yes, I believe, like I told you, at the beginning, it's like it's happy hour somewhere in the world, right? There's always a happy hour going on somewhere. It's the same thing. There's always an opportunity somewhere. And so Ferdinand named a couple of things. Commodities, yes, typically in times like this in the market, commodities are a good option. So does that mean investing in oil companies? Does that mean investing in ETFs that are more commodity driven? Is it investing in gold? So all of these are options if the person says, okay, how do I invest in commodities? That's one. The other piece was dividend stocks. I completely agree. Dividend stocks have a strength to them where if it's paying, let's say, a 5% dividend, which you can find right now with some of the stocks that are a little bit more, they've been ignored, right? Because what's happened in this market is that growth stocks, the tech stocks, right? The Apples of the world, the DocuSigns, the Pelotons, those were the ones that were actually given a lot of attention, especially during the pandemic. They were the stocks that were the at-home stocks, they were called. So those were all growth stocks. They went all up We didn't understand, why the fundamentals, like the actual numbers of the company wasn't there, but they were promising. And so then now we've seen them come back down, right? So typically, just because we are in an inflationary environment doesn't mean that all stocks are bad. Typically, growth stocks are the ones that aren't that great, and we've already seen them come down. So dividend stocks offer the ability to pay a 4 or 5% dividend while you wait for your stock to come back up. It doesn't mean that it won't go down. If the market comes down, it will, but it just may not come down as much as growth stocks would. And then it also, while you wait, there's that percentage. What I do want to see from Ferdinand's point of view is where in the real estate market you see opportunity, because I feel that the real estate market has been it's very inflated right now, and it feels to me very similar, not exactly, but similar to the 2007, 2008 timeframe. Now, am I saying the same thing is going to happen? No, that was a complete financial crisis. But where are you seeing the opportunity? I want to know, because commercial real estate, as you know, has been feeling pain, especially since the pandemic. And now people are realizing, oh shit, I can work from my house. I don't need to have a building anymore. So even hotels have started to, they've actually gone out of business, and people have purchased them for multifamily units, which I think is a brilliant idea. But where are you seeing opportunity? I would want to know, because I just feel like the cycle that is in real estate, there is a cycle. There's 100% a cycle, and it happens every about 10 years. And so then we're kind of there, and I'm hesitant to put money into the real estate market. So I'd love to hear from Ferdinand where he sees this opportunity.
Well, that's. I will, Juliana, send her my essay that I did 3 weeks ago.
I was thinking Ferdinand he's gonna be like, where do I start? This is not a bubble.
No, I can summarize it, but it's just the essay is for everybody that wants it. But basically, Joyce, I will answer in this way. And I talk about statistics, and perhaps my essay compares precisely 2006 with today. Mm-hmm. If you look at it, the absorption rate, let's talk about statistics. Mm-hmm. The absorption rate today, the average inventory in the United States is around 4 months inventory. Right now it's running at 1.9. 4 months is low. Right now, 1.9 is excessively dry. The absorption rate is 19 days. The average absorption rate was around 45 days. We have a deficit of housing because the last 10 years after Dodd-Frank, most of the builders, they were out of business, or they were not building single family homes. So we created a deficit in the United States of 6.5 million single family units that we need. The other thing that we have that you should take a look at it is the new millennials that in the 70s, baby boomers, you are not baby boomers. Joyce is not baby boomer. Juliana is not baby boomer. I am baby boomer. You are millennials. You got it.
I'm Gen X.
Do you know that right now the millennials are going through the cycle in life that they have to make a decision to buy a home, that a dog is not enough?
Ferdinand,
so basically they are racing right now, and they have to buy new homes. So you are talking about a new demand that wasn't there, plus you got this huge deficit. There is another thing that is about debt to income that I did analysis on it. And basically with the pandemic, Joyce, mm-hmm. most of the people, Bank of America said that in the last 35 years, they haven't seen that much amount in the checking account balances. And that's because there is a lot of floating and a lot of money that people in the pandemic save, and they use it to pay down debt. So basically, The debt to income in 2006 versus today, we're in a much better shape with the consumer. Dodd-Frank, I know it was criticized, but I will tell you the good thing that it did. It brought back discipline to the banking industry. It brought back discipline to what it's prudent from the financial standpoint. So when you add up better debt income structure, more liquidity and better wages, low unemployment, high demand, low supply, and a new amount of millions of people that they want to buy a home, because remember, the home is not longer a home. It's where you watch Netflix. It's where you ride Peloton. It's where you do Zooms and work. So it has become a quasi commercial property. And that's why you are seeing the situation with the prices. And that's what I think we're in the first inning of a 9-inning ballgame. That's my personal view.
So basically, the commercial real estate was in a lot of pain. Rafael knows that. He's an expert in that. He's in our audience today. Commercial real estate is going through a transformation. Why? Because it is true that the house has become the business, right? And then and Ferdinand was talking about an overflow of money. There's been talks about all the businesses that started also during the pandemic that, for the first year or so, were not necessarily reported. So there's a lot, there's like a second market going on. Commercial real estate is doing great in Florida, Rafael. That's what I wanted to touch on right now. There's different markets. We talk about the US as a market, but the US is so big that you kind of have to divide it as well. And it's not the same, the New York or New Jersey real estate market, where maybe it's more maxed out and where you have tons of people leaving that state. Those are the states that even before the pandemic, more people were leaving, apparently. Then when you're talking about Florida with such a huge growth, that I saw the other day something that was saying, I don't know if it was 100 or 200% more flights. I don't know. I was like, what is going on here in this state, right? They're having to increase all the airports because they can't fit in all the flights for people flying in, not just for vacation, but also to live in, right, and do business. So you have very different markets, and I'm sure Ohio is a total different market as well, right? So we have a global situation in this country, but then there's also smaller markets, right? The tri-state area, Florida, you have Georgia, right, with everything that's going on there, California. And I think that when you talk about commercial and residential real estate, there's going to be differences. And then when it comes to residential, there's states where there's more opportunity. And Ferdinand, I'd love for you to touch on that, because I think that's a little bit where Joyce, her question is, like, if I'm going to invest in real estate, where should I be investing? Because we know also that with economic cycles, there's times for fix and flips, there's times for new construction, there's times for rental properties, right? You have to figure out what's best right now.
I think that the best right now deal that you can do is develop land in the southern states, in my opinion, in the single family market, either for renting, multifamily, or to resale. No question about it. Higher interest rates are going to take some of the population, and it will disqualify financial on the writing, that they're going to be disqualified. But the demand is so huge. Right now, let me give you an example. Cape Coral, the absorption rate right now, 10 days. We built almost 49 units. We have 10 that I haven't finished. We have bidding wars on it. 35% cash buyers. So yes, there is a phenomenon on the build to rent, because rentals are increasing every year and you have to put a cap on it. So basically, I think that if you do rentals in multifamily market, remember that statistically multifamily follows the trend of the single family. Why? because single family, when you cannot afford or you don't have the down payment or you're not longer able to get financing, you gotta live. So that's why the increase in rents and the demand you are seeing, for example, here in Miami, they're offering me 12 months in advance just to fix the price and you get all that cash flow. That doesn't mean that in the next year, when you renew the lease, there's going to be an increase too. Another thing that you got to look at is that wages are going up.
Yeah.
And since wages are going up, there is an offset in the inflation with the wages. So you are looking at an inflationary environment where single family homes, either you build to rent or you build to sell new construction in Florida, Texas, North Carolina, Tennessee, those areas are extremely hot. The absorption rate, because the trend of demographics is growing from north to south and from higher tax states to lower taxes states. The other thing that we're seeing a phenomenon in Florida that not other state has is the fact of the incremental foreign purchasing. Example, let me give you an example. This was from the Florida Realtor magazine here. For example, the biggest buyers in Tampa, St. Petersburg, Clearwater was Canadians, Colombians, China, and UK. In Sarasota to Cape Coral to Naples, Canadians, Germany, Colombians, Argentinians, Mexico, and UK. In Miami, the biggest purchase of real estate is Colombians, Canadians, Argentinians, Venezuelans, and Peru. So you are seeing, oh, by the way, in Orlando, Juliana, Brazil is the 18%, is the highest foreign investor right now in Orlando. Brazil, Canada, Venezuela, and Colombia. What you're seeing,
not that many people there. They're going to end up with no one in their country.
Well, what happens is that every time that you have a dislocation in the southern countries,
yeah,
that's more money that is flying out of that country into the safest place, which is which? USA. And they're going to look to something that is more similar to it, less cold, better weather, whatever, less taxes, more business friendly. That's basically what it is. And that's what happened in COVID too.
That makes sense. That makes sense. I just wondering though, like, it just seems to me that it is the real estate market is overbought right now. It does seem that way to me. And then there's a couple of things that you mentioned, like the inventory being low. That has been an issue for many years now, but the inventory was low is because, is it the reasoning behind that? Because the rates were very low. So people were borrowing at a very low rate. It was easier for them to swallow being able to say, okay, 30-year at that amount, at that price for this rate, right?
Let me interrupt you there, Joyce, because I know people are scared about the rates that we have right now, but when I bought my first home in Orlando 5 years ago, those were the rates what we have right now.
No, it's not about the rates right now. The rates right now are not that bad. But I'm saying, are the inventories low because, or have they been low because the rates have been low? The lending has been easy, right? And it was something similar to what was happening in the past. Now, is the inventory going to come up, being that there was a lot of people during the pandemic that couldn't pay, right? And then they have, supposedly there is a backup of upcoming foreclosures. And with the recession, if we go into recession, right? If we go into recession in 2023, or let's make it even 2024, we have more of a time frame. Is that going to increase the potential of real estate? Is it going to then correct the real estate market? Like, you don't feel, Ferdinand, at all that there's a correction in the real estate market coming?
I'll let you answer that, and then we'll go with, I know Vivian has a question. She raised her hand.
Yeah, the answer to your question, Joyce, which are very good and very good observations, is the fact that, yes, no question about it, the interest rate, the low interest rates have motivated buyers. But at the same time, during 2004, 2005, 2006, when George W. Bush proposed that every American should have a home, he just created, with easy financing, basically create a bubble. That's not what we're seeing here. What we're seeing here is a deficit of construction. USA used to build 1.2 million single-family homes per year. In the last 10 years, they only have built around 775,000. So basically, it's a distortion of supply and demand versus 2006, where we had a surplus of almost 3 million units. So the only thing that you got to look at is this. If you got a rental, here in Miami, the average rental is around $2,800 per month. Can you buy with $2,800 per month a $500,000 house at a 5% rate like I calculated yesterday? Hell yes. Perhaps the payment is going to be around $2,020. Add property taxes, add the insurance, you're still compatible and you have a home. That's why the numbers make sense. Instead of renting, to buy, and that is really somewhat different in the 2006. Let me tell you one, Joyce. In Cape Coral, they sell in 2006 for $450,000. That's crazy. That is absolutely insane. It was a real bubble of free money, no verification of income, debt to income ratios exploding, and definitely you got a huge amount of defaults. And when I agree, when the recession came in 2008, that's when the whole house of cards really started crumbling and everything fall apart. But what I'm seeing is that I think, Joyce, that as the rates goes up, you are going to see some leveling off of the market. I received that information from Zillow, which I was surprised. My numbers, and Juliana knows this, I said that in a couple of radio shows, I expect around 6 to 8% increase this year. Zillow is expecting 16% increase in homes this year. Double what I expected. And I am a builder, by the way. So I think that the expectations, I agree with you. It feels like it, but when you get into the hood, you open the hood, it's a BMW, it's a motor, it's running well. It's not a Volkswagen. The mechanics are there, you know, because you sometimes they sell you like this is a BMW, and when you open it, it's a Volkswagen motor. No, I think that the mechanics are there. I think that the fundamentals are there, that we're going to have somewhat of a diminishing of demand. Yes, of course, we will. We should have it. And I think it will be healthy for everybody.
Right,
but,
like a correction of the real estate market.
Let me add something, Joyce. When I told you, when I bought the first home 5 years ago, and not even 5 years, 4 years ago, right before the pandemic, here in Florida, the demand was already, and it was the rates were like 5%. The demand was already crazy here. So it's not that the pandemic created it or the rates going down created it. Is that we just saw the beginning of what's already happening, right? But every state is different, and that's definitely something that people should look into. Vivian has a question, and I'd like to let her ask her question. I can't hear you. Hold on, let me see if I can. You gotta unmute. Vivian. Lower hand. I don't know why I can't hear you. Maybe raise your volume.
Or she can put the question in the chat box.
Yeah, put the question in the chat box. That might work. Let's see.
But while she puts that question in the chat box, I'm going to keep asking Ferdinand questions, because Ferdinand, no, I'm telling you, I love real estate. I really do. I'm a firm believer in real estate. I just want to understand, just my view. And I know that we may disagree in certain things, right? But like, I agree with what Ferdinand is saying, and some of the things that you've been telling me, this is good because it's eye-opening. It's things that I didn't look at, right? But how long do you think before we see a correction in the real estate market? Because everything, like we said, everything is a cycle, and this cycle is coming towards that. And one of the things, it's like a saying they have in the market is Florida is like the last one. It's the one when Florida is the hottest, is at the point of its hottest, that's when you kind of know the real estate market's coming down. And Florida's at its hottest right now. Maybe it has more to go, but how long do you think before we see a correction in the market, real estate market?
I think the correction of the market will come by different indicators that I will share with you on the audience. Let me explain first what is the importance of the yield curve, because everybody's talking about yield curve. Basically, the yield curve is very simple. It's the amount of maturity of a fixed income paper from the government, and you got different maturities. The logic is that shorter term maturities pay less income than longer term maturities. That's a sign of a healthy market. Right now, don't listen to the press. We are not there yet. We're still having somewhat of a flattening of the 10 to 30 years, but if you look the shape of the curve, it's not inverted yet.
Not yet.
Inverted means, and when you look the 10-year versus the three-month treasury bill, still in a healthy steep yield curve. So when you look at those two indicators, and both of them, they are negative, and we are hitting probably to a recession level, that's when you're going to start seeing, and you got higher interest rates. Probably we got to hit around 6.5% to 7% to get, in my opinion, a correction. Why I do that? Because I do an amortization schedule. Let's suppose that your average home is around $350,000, and you calculate at 6% the interest rate in a 30-year amortization. Basically, it's going to give you around $2,100 per month at taxes. You compare that with rent, how much my landlord is charging. When you see that then buying is not as good as renting, and that's because interest rates are going so high and recession causes unemployment, that's when, Joyce, things are going to start to correct. And that's when I think you got to make a transition and you got to adjust. What happened is that Juliana knows that one of my funds is that I always find a bull market in real estate. We did it in distress. We did very well in distress. There are strategies that you do in distress. I did owner financing. I did lease to own. I did apply a lot of techniques that I teach to some of my students and people on how to work with recessions or deflation. But at this stage, I believe that still we are 24 months out of a major correction in the real estate market, in my opinion. And the reason is because home builders are not building still as fast as the market is requesting. Right now, with the supply chain, there is a lot of people that they're not motivated to build, because you know that the politics of the world, the Lennar of the world, the Toll Brothers of the world, they have to make a huge amount of a spread in order to comply with the numbers of earnings price and all the analysts that they're following the public stock. But for boutique builders like me, this is a dream come true. This is a blue ocean. Because I don't need those margins, and I can flexible flipping away, and I can do it from build to sell. I can do it build to rent, and we're still making good cap rates. The other thing is that the cap rate is important. You gotta measure how much you make in a fixed income investment versus renting. And when I mean renting, is net operating income, is income, gross revenue, less taxes, less insurance, less allowance for vacancies. If that cap rate is better than fixed income alternatives as they are today, I don't think that you're going to see a correction. You're going to see family office money and institutional money dumping into multifamily projects. But when the equation says that you are getting a 6% free risk treasury note bond and your cap rate is only 3%, that's when things are going to start to unfold and probably correct. So my answer to you will be that the comparables and the supply and demand, it's going to dictate when the correction will come. I don't see that coming in the next 24 months as I see it, because people they're seeing that there is a huge need of housing right now. There is a huge shortage.
So based on treasury yields, right? So it's very similar to what we do with the stock market, and then based on the other thing you mentioned was
the amount of the comparison of renting versus owning.
Oh, gotcha, the cap rate.
And the other thing is the absorption rates. It means how much the builders are starting to build new homes versus the demand. When you start seeing that crossing over, where supply is exceeding the demand, that's when things are going to unfold with the cap rates and the interest rate comparison.
Okay, so I'm sorry. We have Vivian wrote her question, and I know we kind of like forgot about the question. Sorry, Vivian.
Sure.
And I see her shaking her head and nodding, so she's like agreeing with some stuff and not with others. She wants to know what is the opinion on the consumers that negotiate a forbiddance with their current loans during the pandemic. And I heard from several people who work at banks that the banks don't want to repeat what happened in the past, that they don't want to end up with an overflow of properties that they can't even sell. So they're kind of trying to work out with a lot of people to see how to avoid those foreclosures.
They can talk to me. Right? They can talk to me, and I can buy distress. I'm not afraid of distress. I can buy mortgage paper and restructure it. I love those things. But unfortunately, the banks know that there is a lot of equity. There is a big difference, 10, 11 years, because your home has a lot of equity, and you can really restructure the debt. I can do it in a heartbeat. You can talk to me every day. I can do it for you. But the big thing is that in the past, 2006, 2007, you got negative amortization by speculation of interest rate, easy money. You got negative equity in some of the homes. That's not the situation right now.
Yeah.
So basically, because you have equity.
What do you think? Are we really going to see a lot of foreclosures? I guess that's where the question's going.
I will buy them.
Are the banks really going to take out their homes, or are they really going to negotiate the forbiddance?
Juliana, I have a question for you. If you have a loan of $200,000 and your home is worth right now $400,000 and you cannot pay the monthly payment, what do you do?
I sell all the way.
I buy the paper anytime. I make 100% return if you want to. And a cap rate, and by the way, a cap rate double, triple of what the treasury bond is paying. More than 7% anytime. I would take that deal anytime.
Yes, because why am I going to lose the house and end up with issues in my credit when I can just cash out?
That was the different situation when I work in distress. The lady say, listen, I have a loan of $200,000. The appraisal came at $175,000. Why in the heck I'm gonna keep paying the property taxes and insurance if I don't have the money to keep it? He had negative equity. That's not the situation right now.
No.
So
that's
Ferdinand,
why I don't think.
Are you saying that the banks would work with the consumers and they're going to be saying, oh, you know what, that's okay, we're gonna renegotiate these terms, or are you saying that they will try to get them out? So
they will get them out, and immediately they are going to sell a package
sell
to
the
us,
property,
and we will buy them all.
Right.
But the situation is that because of the equity, the consumers, not every, there's very smart consumers out there as well. So a lot of consumers may avoid those foreclosure situations by just actually selling.
That's one, they can sell. And there is a lot of private money, hard money loans out there that they will be willing to lend the money to get the deal and just wait.
Sure.
And you won't lose your home.
I guess it's just going to depend. It's going to depend on how much the properties come down, right? If they come down as much as they did back in the day, then we're screwed. And then the people, you are going to see a lot more foreclosures. Being that this time around, it doesn't seem like the property prices will come down as much. I mean, back in 2006, 2007, that was a financial crisis. There was way more going on than there is now, at least in the housing market. So at that point, at this time around, will it come down? Yes. Whoever bought their house maybe 3 years ago, 4 years ago, and they're underwater, or it's really not making sense for them, then that could be going into foreclosures. But people that have purchased the houses a good amount where there is some equity, that if they sell, they'll either break even or make some, then that could be helpful for them.
I will tell you one thing that happened to me, and this is real case. Like I said to my people, I talk with facts. I don't talk with emotion. I talk with facts, and when I do building, I don't delegate, I go. So I'm telling you from the field experience. I had a mortgage note that we financed in Miami Beach. This was a LLC company. By the way, it was a Brazilian company. They went in default. They didn't pay me. I went to foreclosure. We wait almost a year and a half. They pay 18% interest rate because that's the default rate in Florida. It's not that I'm being a shark. That's the default rate in Florida. I got paid all legal fees. And I told the guy, listen, you don't have to pay me. I can take over the property. I'm not afraid to take it because we will do a rent. I was very honest with him. I say, no. I'm not going to do that. I'm going to find you the money for that. He paid me off last week. And I know how he did it.
Well,
he got a hard money lender. He got a hard money lender. He paid me off at 6%, and now he's paying 10%. But because the rental market in Miami Beach is so hot, he's renting the property and he's producing positive cash flow with the rental. He's paying the 10% until he gets his act together. That's the difference of this time versus the last time.
We ended up talking a lot about real estate, which I think is great. I know there's questions that are like, I'm not gonna have time to make, so maybe we'll have to come back another day. But I want, so you guys talk a lot about correction, right? But correction doesn't necessarily mean crash. And a lot of people have that misunderstanding, right? We're talking about things getting back to like what should be more of a normal state, not going at the phase that it is going. So when I think it's important to remind people that when we talk about correction, and when you guys talk about correction, it doesn't necessarily mean that things are going to be bad or bad economy or a crash or anything like that. It just means that we're not going to be speeding at the velocity that we are right now, because it feels like a Formula One race, right?
Juliana, facts over gossip or press? Just look at the yield curve. What the yield curve is telling you, which is very smart people, banks all over the world, is the curve is flattening. Flattening curve means slow down. It means that we're going to slow down the economy. We're not going to go to a recession yet. I mentioned this. Yes. We're in a 35% right now recession. It was 25% 2 months ago before Ukraine. But right now, we're not telling, the curve is not telling you, the facts are not telling you recession. I got the statistics today of the money supply and the Federal Reserve of St. Louis, which is my favorite bank, by the way. I follow Atlanta, I follow St. Louis. I don't follow New York, sorry guys. Basically, those are the most accurate in predicting recessions. Federal Reserve of San Luis and Federal Reserve of Atlanta. Both, they're saying there is no hedge of recession right now. We're way out.
Right now, I wouldn't say way out, but I would say right now there's none, right? Because it's right now it's flattened, but it did touch the inversion the other day, right?
That was the 29.
If we're looking at the 2-year and 10-year, right? Then typically when that inverts, it usually is a time frame of about 24 months. It could be anywhere between a year to a year and a half, typically, maybe 2, when that inversion happens. The other one to look at, and you mentioned it too, is the 3-month, right? So if we look at the 3-month and the 10-year, then we're looking at 6 months of the time frame. So it typically is within about 6 months. That's when it's closer, the recession is closer. My personal opinion, is we're going to see a correction of the real estate market within 2 years. And I think that Ferdinand, your similar opinion there, that we'll see a correction, and of course of the markets. And I do think unless the Fed can help it, but I do think we're going to see a recession because we're going in the cycle. We're doing inflation. So we had inflation already. We've already moved on to stagflation, and the next piece is recession. So unless the Fed can stop that, which I don't think that they'll be able to stop it for that long, I think we see a recession by 2023, towards the end of maybe 2023. My view, my opinion.
Okay. All right. So we're going to leave it there because it's 1 p.m. And we've been here for an hour. But I'd love to bring you guys over again because I had so many questions about this crypto here to stay. How's cryptocurrency going to affect the real estate market as well? Because now we're doing closings in crypto in some states, right? All this cool stuff. But we don't have time for it. So maybe we just gotta go back. Vivian saying thank you, Joyce and Ferdinand, for all the valuable information. Guys, if you have any last questions, maybe you can drop them there and I'll ask them to answer them. Yes, we are going to be giving you a link to the recorded version of this workshop, conference, debate. I would like it to call it debate. It's kind of like a debate more. So we hope to see you soon. And thank you so much for connecting today.
Thank you, everybody. Thank you, Joyce.
Bye,
Thanks,
everybody. Thanks, Ferdinand.
Nice to meet you personally. I hope to meet you personally.
Yeah, that would be great. That would be, where are you? You're not in Florida. Are you in
Yes,
Florida?
I am in Miami.
Oh, you are in Florida. Okay, in Miami. So that's why you know the Miami market very well.
He's in Brickell. He's the other financial. He's in Brickell. So yes.
Very nice. No. Like I said earlier before, hold on, let me. Oh, you're still recording. I thought I was recording for some reason. Hold on. No, so then yes, the information on the real estate was great information, Ferdinand. So thank you for that. Because
anytime, in case that you want to read the I think Juliana has it. It's in English and in Spanish.
Yeah.
Okay.
Basically, okay, analyze it. I'm adding more content in this week. I'm working in more stats, so we will do, and I will share with you. Okay?
Yeah. No, sounds good. And then next time we speak, then I'd want to hear what you're thinking about. How are you going to take advantage of the recession coming up? Because that's also an opportunity, right? Recessions are opportunities for people that are ready.
We are really salivating about that because I will be much better off.
You and I both.
Okay, so we have the subject for the next one. Okay, great.
All right.
Bye.
Thank you, everyone.
Bye-bye.